guys. Well, thank you very much for coming on to this presentation. Before we start, a bit about us. We work exclusively with sort of startups and high growth businesses. It's actually quite a loose term. So our clients literally range from pre-incorporation founders all the way through to sort of Series B, Series C companies. A large part of what we do is actually M&A. So as you can imagine, the idea of, I suspect all of our founders actually, is that they want to get sold at some point. And that can happen earlier stage or later stage. I would say probably a good chunk of our clients get sold sort of around the Series B, Series C. So, relatively big numbers, founders are making, a good bit of cash out of it. But this session really is much more about buying distressed assets. So in terms of the current environment, obviously what we have is a bit of a credit crunch. We've got a lot of startups in particular who, they have perhaps tried to grow and scale. They haven't been as successful as they hoped. And as a result, they've run out of money. You're increasingly also finding that investors who perhaps previously would have followed on, if they're not seeing that growth and traction, they're saying, well, we don't want to put any more money in. And as a result, the businesses are on the point of going bust. So lots and lots of businesses out there, including lots of better capitalized startups, are actually now taking the opportunity to acquire assets on the cheap. And that really is sort of what this topic is about. So in terms of the actual transaction that we're thinking about by way of a case study, this was actually a transaction that we did just before Christmas of last year. So our client, we're actually on the buy side. Our client is a very well capitalized startup. So they've raised tens of millions of pounds from a bunch of really, really good VCs actually. And they came across this other startup that unfortunately had run out of cash, wasn't able to raise further investment. And they had got really two things that they wanted. They got a bit of software that they wanted to buy really as an asset and plug into their own platform. And the argument behind that was it was something that they then didn't have to develop. So it was saving them time and money. And they also wanted to get hold of this particular company's client contracts. So they had a really, really very amazing set of client contacts. So, blue chip companies all using this particular bit of software. And our client, being slightly flippant, wanted the opportunity to pitch to these people. And that was a huge draw to sort of to entering into the transaction. The transaction, pretty de minimis, 100 grand in cash to all the shareholders. It sounds a lot, but actually when you think that this company was a startup that had raised several rounds of investment, the investors were getting pennies in the pound back on their investment. So not a deal that really excited anybody on the sell side. And crucially, they instructed us, I think it was the second week, or maybe the end of the first week in December. So 3 weeks to Christmas, everybody wanted this done before Christmas. And crucially, if the transaction hadn't gone through before Christmas, the company would have gone bust. So it would have just been put into liquidation and that would have been that. So that's the transaction we're talking about. In terms of the structure for this discussion, we're really going to look at three key topics. The first one is structuring acquisitions of distressed businesses. So really we're thinking here about how do you do it? What sort of structures are we looking at? What are the key things to think about? Second topic is due diligence. So this is about figuring out what it is that we're actually buying. And then the final one is how does all of that information that we've gathered about the target in the context of due diligence, how does that feed into the contractual terms? So the SPA or the asset purchase agreement. And we'll have a little bit of a think about that. At the end of each section, Ivan will pop up and ask any questions that have been raised. So if you do have questions, pop them in the chat. And Ivan will try and answer some of those at the end of each section. And then if we've got any that we haven't covered, we'll cover those at the end. I should say this is a very artificial structure, but theoretically we're going to have a chat. So we'll see how that one goes. All right. First topic then, structuring the transaction. So in terms of how you go about acquiring a business, there's really two approaches. You can do a share sale. We can do an asset sale. So Mary, do you want to tell us about those structures and how they differ?
Yeah, so the first one being a share sale. So essentially here what you'd be doing as a buyer is buying the shares from the shareholders in the target and essentially purchasing them as your own. So you become the shareholders, and the entity essentially sits below. It stayed the same. You inherit all assets and liabilities relating to that entity. And how that differs to an asset sale is basically with an asset sale, you will be buying the specific assets and liabilities from the entity itself. So the entity, the target is the seller essentially, and that gives you a lot more flexibility because, like I say, you can essentially pick and choose which assets you're buying, whether depending on what you're interested in, whether that's the contracts, certain IP or software. So it gives you a bit more flexibility.
Yeah, and I think in the context of the transaction we did before Christmas, as I said, their key interest was in acquiring the contracts and software. And so you might think that it would have made sense for them perhaps to do an asset sale because, key difference would have been that, or the key problem we had with the share sale was that because they were buying a company, they were acquiring all of the liabilities, all of the problems in that company. Whereas had they done an asset sale, they could have picked and chosen the assets and just got what they wanted. Now, we actually went for a share sale. And the reason for that was that when you do an asset sale, every single asset you buy has to be physically transferred. And so in terms of contracts, that not always, but generally means that the contractual counterparties will have to sign a piece of paper in order for that contract to move from the seller to the buyer. And our clients were very, very keen. They did not want to be pestering these blue chip clients to sign bits of paper in the 2 weeks before Christmas. They wanted to make sure those contracts transferred across, and in the fullness of time in 2023, they could contact the customers, at the right time with the right pitch. So that was really the big driver from the client side in going for a share sale. So once you've figured out your structure, whether it's a share sale or an asset sale, you then have to figure out how you're going to pay for the consideration, if you like. So in our transaction, it was nice and straightforward. The consideration for the target was 100 grand, and we paid it all in cash. So we just gave them, as it says on the tin, cash on completion. There are two other things you can do though. So you can do loan considerations. So effectively all that is saying is we're going to give you cash, but we're going to give it to you later. So we're going to owe that money to you. And you can put all sorts of strings around it, but in essence, that's all it is. And then the third structure is share consideration. So Mary, tell us a little bit about what share consideration is and why it may not always be the best thing for the buyer.
Yeah, so share consideration essentially would be you issuing shares to the sellers in your company rather than cash on completion. So essentially the sellers become a shareholder of your company. And that could be good for them for a couple of reasons, i.e. the seller, because they may get certain tax benefits. They're not receiving cash on completion, it's a share that they're obtaining, so there could be tax benefits for them. But like we say, it could be slightly disadvantageous for the buyer in certain circumstances. Especially because if you think sort of as part of negotiating the deal, you're going to have to deal with share consideration. So you're going to have extra documentation to be able to allot the shares in your company to the sellers. That's going to mean getting consents from investors potentially. And it also means that you're going to be having, rather than sort of giving them cash on completion and having that be done with it, you basically then got an additional shareholder sat on your cap table. And so that's, share capital percentage given away to a shareholder. And it could also mean that if you, as envisaged, create bigger value in the company, when you come to sell, you essentially could be giving away greater value in the company to the sellers than what you would necessarily have given to them in cash on completion. So I guess that's something to think about.
Yeah, and that last topic is always the key for me. So I think a lot of buyers, particularly at the moment where cash is king and there's a credit crunch, all this kind of stuff, I think a lot of buyers think to themselves, well, if we can not give cash and we can instead give shares, then that's a better deal. And, it might be, but you have to remember that, what you're doing is you're giving the selling shareholders shares in your company. And if your business is successful and it grows and you sell for hundreds of millions of quid, they've potentially got a huge amount of extra value as a result of holding those shares. we actually thought about it in the context of the transaction as a case study, because, to be frank, the investors in the startup didn't particularly want to be paying out 100 grand's worth of cash. But very quickly, the client said to themselves and realised that actually their aims for their business was to sell for 250 million quid. And if you did the maths on the equity that we would have given away, the shareholders would have got 5-6 times 100 grand for an asset that was worth 100 grand. So I think, have a think about that one. It's also, having said all of that, it's also worth thinking about it from the sell side perspective. If you don't want to pay cash, equity can be a really good thing to offer sellers, because if you think about our transaction that we're using as a case study, you've got investors in that business who'd invested, it was millions of pounds, and they are getting in aggregate 100 grand back, so pennies in the pound back. They're not happy about it, and frankly, the consideration they were getting was pretty much de minimis. Had the way to have pitched a share deal to them would have been to say, well, you get a second bite of the cherry. We think as the buyer, we're going to be hugely successful. Maybe you'll get a good exit out of having shares in us. So you can flip it and you can use it as an incentive. Now, Mary and I are actually working on something at the moment that is a distressed sale. And we're worrying in particular, it's an asset purchase, so we're looking at buying some assets. We're actually worried very much about the selling entity going bust soon after the sale. So Mary, do you want to just explain sort of why that's an issue and and what we can do about it?
Yes, so essentially, if you complete, let's say you're trying to do an asset sale because you just want certain assets of the company. If you try and complete that and then subsequently, really soon after completion, the company goes into liquidation, the issue there could be that the liquidator tries to unravel some of those, that purchase on the basis that it was too low, for example, just so that they can try and claw back a bit more money for the creditors. So to try and avoid that, you could essentially complete the purchase before it goes into liquidation, and then essentially you'd be doing it via a share sale. So if you purchase the shares before, you'd basically, the only downside to that is that if you were wanting to only purchase the assets before, now you'd be buying the shares, so you'd be buying the assets and the liabilities of the company. You'd also have to keep the company solvent, and that'd be your responsibility. If you sort of let it go into liquidation, you appoint a liquidator. That might be good because you know that essentially your purchase won't be unwound post-completion, but you're not going to get nearly enough sort of buy-side protection that you'd normally see in a straight seller to buy a transaction. And it also could slow down the process as well if you're having to go through the process of appointing a liquidator. So there's a couple of ways you can sort of structure it, but they're the real sort of considerations you'd have to make.
And it's something, as I said, that we're dealing with at the moment, because we're buying some assets off a company that is very close to insolvency. And the concern that we have is that what will happen after we've done the transaction is that the selling shareholders will just push the company into insolvency, have a liquidator appointed, and then the liquidator is obviously free to try to challenge the transaction by which we bought the assets. So we're trying to balance at the moment, do we, as Mary said, do a share sale? If we do a share sale, well, we have control of the business, so we know it's not going to go bust, but also we take a load of liability. And in this particular case, the liabilities are huge. And so we don't really know that we want to do that. But then the flip is we can push it into liquidation now, buy the assets off the liquidator. That leaves the liabilities behind, so we don't have to worry about them because we're just buying assets. But we don't get any warranties as to title. We get no real sort of protections from the liquidator. And the thing that's most important to the client that we're dealing with at the moment is that it will slow the process down by 5 or 6 weeks. So weirdly, when a company appoints a liquidator, that actually happens at the end of the process almost. So before the liquidator is appointed, there's generally somewhere between about 4 and 8 weeks of prep work where the liquidator figures out, being flippant, whether they even want to be involved. And only once that's happened, shareholder resolutions are passed, and then the liquidator is appointed. It's pretty rare to do this process in less than 4 or 5 weeks. So, putting it into liquidation is probably actually the best option for this particular client, but it will slow things down, pretty massively. Okay, so that's the end of the first section. Ivan, have we got any questions so far?
Yes, thanks guys for that. We actually have a few questions, and the first question is from Adil. Do employees and employee claims pass to the buyer on completion?
So I take that one. So, so employees are slightly weird. So if you think about what we said about a share sale, so in share sales, you're buying the company, and therefore any issues at all, you're buying that they belong to the company. You're buying those issues. So with share sales, you get the employees because they're still employed by the same employer. You just bought the employer, and if anybody has a claim against the company you're buying, you get that problem as well. So share sale, everything passes effectively. You might think that with an asset sale, that isn't the problem because you're not buying the employees if you don't want them. But unfortunately, there's a piece of legislation called 2P, which basically says that where you buy the business of a company, so in layman's terms, substantially all of the assets, where you buy the business, the employees and any employee claims automatically pass to the buyer. And so you find that any employees employed by the business suddenly are employed by you, and any employee claims are passed over as well. So that's what happens on a business. If you're just buying a couple of assets, so you're buying, I don't know, a website maybe, but nothing goes with it, no customers, no nothing, then the employees shouldn't transfer across. But if you're buying a business, then they will do. So where you're doing an asset purchase, you just want to make sure that the lawyers have thought about it and that they've figured out whether 2P applies or not.
Perfect. Thank you so much, Mike. We've got one more question, and that's from Francis. Do I have to keep employees of the target?
Do you need to keep the employees? I guess it's a question of whether you want to keep them. If you do, then, as Mike was saying, I guess under asset sales and especially share sales, it's going to be the case that you're going to have to sort of keep them anyway. There are ways to deal with if you didn't want to keep them, and they, if there was some that was staying for any reason, you might not get it in a distressed purchase, but if there was some that was staying with the business, there is a process you can go through under the legislation to give them a consultation period to enable them to sort of not fall outside of the legislation. If you didn't want to keep them and they do transfer, there's always, I guess, redundancy processes that you can explore. There is a very high level, obviously you would be able to do that if they hadn't been employed with the company for 2 years, but that's certainly something you can explore sort of post-completion as well.
And I think the thing sometimes you have to ask yourself is if, let's say you're doing a share sale and you've got a bunch of employees that you don't want, sometimes it makes sense to actually get the seller to get rid of them. So the seller will terminate, go through a redundancy process. You do just need to be a little bit careful though, because as we said, if there are employment claims that arise as a result of an improperly effected redundancy process, they're going to be your problem. So whilst from a sort of practical perspective, it can make sense to get the seller to get rid of any employees you don't want, you do need to make sure that you keep an eye on what they're up to and that they follow the right procedure and get it right. And the crucial thing here is redundancy is much more complicated than most people think, and it's incredibly easy to get it wrong. If you get it wrong, then you probably have an unfair dismissal claim, which can be pretty expensive. So yeah, be careful with that kind of stuff. And employees is something that lawyers on transactions probably spend a disproportionate amount of their time worrying about.
Perfect. Thank you so much, guys. We don't have any more questions at the moment, so I would encourage everyone to share their questions in the Q&A section on your screen. There are lots of attendees tonight, so we'll try to answer as many as possible questions, so feel free to ask. Thanks, guys.
Cool. So the next section then is due diligence. So well, I might actually turn it over to you, Mary. What is due diligence? Why do we do it? Why does it matter?
Yeah, so due diligence is essentially something that you may sort of leading up to negotiations, pre-heads of term stage, you'll have an idea of what you want to buy on a very high level. Post signing the heads of terms, you then begin the due diligence process, and that will basically take up the time between post heads of terms up to drafting sort of the first set of main transaction documents. And that is essentially a fact-finding exercise by the buy side, essentially trying to uncover everything they can information-wise about the entity or the assets that are being purchased. And how the form that takes is essentially your legal team will draft a questionnaire, a due diligence questionnaire, which will essentially be asking questions about various aspects of the business, so IP, contracts, that sort of thing. And essentially we expect the seller to provide responses to that. Essentially, you're wanting to uncover as much as possible anything that I think we were saying basically smells in relation to that company. And it might take a different form depending on whether you're structuring it via a share purchase or asset purchase. Obviously, because with a share purchase, you're going to be buying the company warts and all. So you're going to want to know sort of everything there is to know about that company and its liabilities. Whereas with an asset purchase, you're probably going to focus it a bit more onto whatever assets that are making up the key part of the deal.
I think the interesting difference between distressed purchases and your standard 200 million quid M&A transaction is really the way that the lawyers behave, or more correctly, should behave. If you think about a 200 million quid transaction, the DD list, the due diligence request list, is probably about 20 pages long. And bluntly, where the lawyers are coming from is we want to know absolutely everything about the business, because we want to understand where the problems are. And from our client's perspective, they want to understand, frankly, every single problem. On a distressed deal, for obvious reasons, you can't do it. Think about our transaction where we had 3 weeks to get this done. A 200 million quid DD process probably takes about 6 weeks at least. So you just can't do that. So what the buy side lawyers should be doing is talking to their client and saying, all right, what is it we really care about? And how are we going to provide a questionnaire and create a process that the sellers can engage with nice and easily. We can get the information we need, and we can get this done in a safe but quick manner. So that really comes down to focusing on the key risks that we're trying to protect against. So Mary, what sort of things do we tend to worry about in a sort of standard distress deal?
Yeah, so like Mike was saying, it's basically going to be anything centered around what you're buying. And what I know we tend to see is, obviously, if it's software related, we're going to want to know who owns the IP. Is it definitely owned by the company that we're buying? Is it owned by an employee that's left? That sort of thing. Key contracts as well, like the transaction that we did before Christmas. We're going to want to make sure that those contracts are properly written up. That we sort of have a knowledge of the pricing structure of those contracts. Are they what we expect? And if not, that could be an issue. Other things as well, more generally, are going to be, of course, the financial and accounting position of the company. Is it as expected when you drill down into the numbers? Because if not, obviously that's going to be an issue. And also things like, if you're doing a share sale, employees is going to be a big one, because as we were mentioning earlier, it's probably likely going to be that those claims and those employees' liability in relation to that comes to you. So that's probably what I'd say is the sort of key stuff that we'd be looking at.
Yeah, and I think the point that Mary alluded to earlier about the sniff test is super important. When you're doing a distressed deal, you have to pretty quickly get a view as to whether this is a company that's going to be riddled with problems or not. And so, if you think about a couple of obvious areas, finance and tax, you want to get the accountants of the buyer to have a quick look. And really what they're looking for is, evidence of things not being done properly. So, tax returns not filed, accounting records that are a mess, silly things like not having accounting systems in place. If you've got businesses that the accountant comes back and goes, not sure about this, well, at that point, maybe you want to dig in more, or actually maybe you just say, this feels a bit risky, let's not do the deal. The same sort of thing applies very often in customer contracts. So it's actually one of the things that amuses us sometimes as lawyers, that we have clients who can be super on it with all matters of legal stuff. So we'll spend huge amounts of time with them on investment rounds, option schemes, doing all sorts of complex stuff. And then when we come to an M&A process and we look at their customer contracts, transpire if they never had any, or if they did, they weren't signed, or weird stuff like that. As a buyer, if you find that kind of thing, then that begins to be sort of a red flag where you begin to question whether this is a safe deal to be doing on a sort of quickie basis, if you like. So talking about sort of founders who do weird things, Mary, we were talking earlier about how sometimes founders can be super relaxed about the need for due diligence. Do you want to tell us a bit about that?
Yeah, it can certainly sometimes happen once you're past the sort of exciting heads of terms, we're going to get the deal done sort of phase. To then have to deal and trudge through and speak with lawyers for long periods of time about certain aspects of business that you might have not considered are important. And you can also find it with sellers as well. Obviously, they're the ones that are having to provide this information. It's funny that they suddenly become sometimes a bit disenfranchised with the process at that point. But I guess the key thing is making sure, especially if you've got like ridiculous amounts of due diligence questions for them to answer. And so I guess then the question becomes, how do you balance that? Because I suppose some things that, buyers sometimes don't consider is that, you might be comfortable with the answers now, what you find out about now, and that you can sort of stop due diligence there. But later down the line, if you come to sell or take on VC investment, or indeed if you've already got VC investors who might need, for example, if you do share consideration to approve the deal, you're essentially going to have to show to them that you've done enough due diligence to maintain the value in the company, to make sure basically what we think is the value in the company is there and it's all sort of tied up well. So I guess it's finding that balance between, making sure due diligence is specific, it's targeted to the areas that we need, and then in those areas it's sort of, we know what we need to know and we've got the right protections in place to deal with any issues.
Yeah, and it's an interesting point about VCs, because you find a lot of VCs are more risk averse than founders. So they have fiduciary obligations to their underlying investors. They need to make sure that the companies they invested in are not doing things that are overly risky. And so, we've certainly had times in the past where the founders have been pretty chilled about due diligence and have said, "Now look, we think we understand this, we know these guys, we trust them." And the VCs have come back and said, "Yeah, well, we don't. So, please go back and do some more digging." Also worth saying, there are some VCs out there, particularly at the moment, who just literally don't do due diligence and don't care about it and are really investing in the founders. And, they're great, but you sort of have to sort of be aware of who your shareholder base is. The final sort of topic on due diligence is really around sort of insured deals. So this is relatively new in the UK market. By relatively, I probably mean about the last 5-6 years, but it's relatively new. So the idea here is that you take out insurance to cover for warranty breaches. And this is useful in a couple of ways. So it can be used to reduce the risk obviously for the buyer. You've got an insurer who's standing behind the warranties. If there is a loss, then they'll pay out some or all of it. But you can actually leverage that to improve terms for the sell side. So, if you think about what can go wrong on deals, you might want to have some sort of retentions in place against consideration. So if there are breaches, you can claim against it. Getting insurance to some extent can negate the need for that. So insurance can seem like quite an attractive thing to do. What I would say is it's very difficult in practice to have an insured deal for a low value distressed asset. And the reason for that's really two things. One, getting insurers on board takes time. We generally quote to clients sort of 4 to 6 weeks at least. If you're trying to get a deal done in a couple of weeks, as we were, it's just not an option. It's not going to happen in the time frame. But also, the insurers need to have a certain level of diligence. So they need to understand that they have the right answers about things for standard WI insurance. That there are other types of insurance that don't need that, but they're a lot more expensive, which actually leads on to the third issue, which is insurance is not cheap for these sorts of things. So, 100 million quid deal we did a couple of months ago, the insurance was about 120 grand. So not particularly big in the context of that deal, but it becomes disproportionately bigger on a smaller deal. So yeah, insurance tends to be less practical for distressed assets. Cool. So Ivan, do we have any questions on this section?
Yes, actually, we do have a couple. And the first question is from Chris. Can I just buy a company without doing any due diligence?
Yeah, you absolutely can. And sellers will probably thank you as well, because that means that their to-do list as part of the transaction is going to go down immensely. But I suppose you're never going to get a lawyer telling you to not do DD. Essentially, it's the equivalent to buying one of those mystery boxes from eBay and waiting to see what it looks like when it turns up on your doorstep. You'd be going into the transaction blind. Like I was saying earlier, you might discover some things about the business or the asset you're buying before heads term stage. Obviously, you're going to get to know the people that you're potentially buying from, but you're never going to know those, hidden smelling things in the company, and that could lead to a huge liability later down the line post completion that you're essentially not protected for. So yeah, wouldn't advise to do that, but it's up to you at the end of the day.
Yeah, I think I would say don't even consider it on a share sale, because on a share sale, God knows what you end up getting. And some assets, some liabilities and some problems can pass up. So you wouldn't, unless you really are a gambler, you wouldn't do it on a share sale. On an asset sale, I think the problem is just you don't necessarily know what you're buying. So you take our example where, we're buying the contracts, but also some software. If you've not done any due diligence, you don't know that actually they own the software. So it could have been that the software's been created by a developer in XYZ place who's never signed an IP transfer agreement, and therefore the developer owns the software, not the company. So you're paying money for an asset that you end up not owning. So I think, I think there's a balance between being sensible, pragmatic, and just saying, well, let's not bother.
Perfect. Thank you so much, guys. We've got a few more questions, and the next question is from Claire. What are the most common problems when you're coming out of due diligence?
So it obviously depends. Sorry. It obviously depends on the business and what it is you're buying. I mean, the things that we tend to see most, or the areas where we tend to see most problems, definitely the financials, not necessarily our problem most of the time, but there is an inevitability to businesses, particularly early stage businesses, where financial processes aren't quite in place, where perhaps they haven't had accounting systems in the early stages and stuff hasn't quite been done right. It's almost inevitable there's going to be some stuff that gets shown up. In parallel with that, tax. I can't think of a single DD process where tax advisors have not turned around and said, we have some concerns about this. It very often tends to be in the employment space and the director space. So we did the deal we did a couple of months ago. There was a bunch of directors' loans and directors' money moving around the businesses. Some of those businesses were in outside the UK. There were a whole bunch of potential PAYE issues and stuff there. It doesn't mean that you can't do the transaction, and it doesn't even mean there's necessarily a tax problem. It's just that the tax advisors are saying there may be an issue, and either we need to bottom it out and figure it out right now so that we know what the answer is, which is not always the right thing to do, or we just need to understand what the risk might be and figure out how to deal with it. So finance tax is one area. Employees, particularly options around employees, that's an area that we see all sorts of weird and wonderful stuff. In terms of options, my advice to anybody granting options to employees or advisors is please just get it done by a lawyer. We see so much weird stuff. And the problem with option agreements is that they relate to the share capital. If you think about a buyer doing a share sale and buying a company, any issues with the share capital are automatically a massive deal because they need to know what they're buying. So if you've got weird and wonderful stuff that's gone on with the employees, that's going to be a red flag, to put it mildly. So sort of employees and cap tables is another space. Other than that, lots of weird and wonderful stuff we've seen over the years. But to be frank, very few that really have tanked a deal. I think the closest we've got to due diligence, sort of tanking a deal was a transaction probably about 5-6 years ago where we had a client who was acquiring some pretty clever tech, and it transpired that one of the founders had created a chunk of that tech, had quit the business and had never actually signed an IP transfer. So a really tiny mistake that was made, but it had a huge impact, and the buyer wasn't prepared to go ahead with it unless that was solved. Thankfully, the founder was pretty cooperative and we got it solved. But, you know, yeah, touch wood, we've never had any major issues.
Perfect. Thank you so much, guys. And let's take one more final question on due diligence. This time, the question is from anonymous attendee, and the question is, what happens if a material fact is found post due diligence? Does the deal fall out, or is there any possible clause which could be inserted to prevent such fallout?
Well, that's an extremely good question, because we are literally about to cover that. So if you hold on to the thoughts, we'll move on to that one in section 3. So this section really is about is almost about that point, right? So you've done all your diligence, you try to figure out what where the problems might be. And you then need to figure out what you need to put into the transaction documentation. So for a share purchase agreement, for an asset purchase agreement. And you're really thinking about, frankly, 2 things. So number 1, how do we make sure that that what we've been told in the context of due diligence is actually true? And then 2, how do we deal with issues that we discovered and that we know are a problem? So Mary, on the first one, how do we make sure that the sellers are telling us the truth?
Yes, essentially what you're done in due diligence, and essentially we want to make sure that what the sellers have told us is true. And so what you use in the transaction documents is something called warranty. And essentially what a warranty is it's a statement of fact made by the seller about the condition of the company at the time that it's bought. So classic example is, we go through due diligence, nothing pops up in terms of litigation. And so we have a warranty in the agreement that says, there's no actual or pending litigation in relation to the target entity. That essentially, if after the transaction completes, we find out that there actually is actual pending litigation in relation to the company, essentially the claim from the buyer's side would be a breach of contract that could be rewarded damages, and we tend to see that in the form of a price adjustment that could be awarded post-completion. And to get there, essentially, the onus would be on the buyer to show that that statement being actually untrue means that there's been a loss in the value of the company as it's bought, so the share seller to the shares that have been bought. And essentially whatever that is would be the reward, essentially, from a warranty claim.
And I think in terms of distressed deals, the difficulty with warranty claims is really, who will stand behind them. So if we take the transaction that we're sort of using as a case study, we get 100 grand of consideration, which is not a lot in the grand scheme of things. Investors in companies will generally not give warranties. So they made a cash investment, they're not involved in running the business. They're not prepared to put themselves at risk if there was a warranty claim. So what you're really looking for is warranties speaking with the management team or maybe the founding team. In this particular transaction, we had 3 founders. They were each getting about 10,000 pounds each out of the sale proceeds. So from their perspective, there was really little incentive to put themselves at risk. They certainly weren't going to stand liability for the full 100 grand or a higher amount, because it just didn't make sense to them. They'd be better to let the company go bust. So what we agreed with them was that they would be on the hook for the first 10,000 pounds of the company's loss. So we had, across the 3 of them, 30,000 pounds worth of coverage. Frankly, the only reason we did it was just because we wanted those founders to have a little bit of skin in the game. So there's a little bit of faith and comfort that they are telling us the truth and doing a proper process in terms of disclosing. Look, 10 grand is not a massive amount. It probably wouldn't have made them go bankrupt, but hopefully it was sufficiently painful that they thought about it in the context of disclosure. Now, just on the final point on warranties, you do have by default protection anyway if the sellers are lying through their teeth. So even on this deal where we said the sellers would be, or the founders would be on the hook for the first £10,000 of the company's loss each, that cap would have fallen away if they had committed fraud. So if they had lied through their teeth, told us stuff that was absolutely untrue, then they would have been on the hook for all of our loss. The problem from a buyer's perspective is that fraud is incredibly difficult to prove. It's a very, very high threshold. So it's pretty rare you're ever going to fall into it. And I mean, it's extreme circumstances where that becomes relevant. So, all right, so that's how we make sure that the sellers are telling us the truth. What then, Mary, do we do about problems that we've identified?
Yeah, so if you know about a specific potential loss, what you'd want to cover, used to cover that is something that's called an indemnity. And that is essentially a promise by the seller to the buyer to reimburse the buyer if they essentially experience any loss post-completion relating to a certain thing. This is better because essentially you don't have that onus of having to prove loss or mitigate loss. The reimbursement would be on a pound-for-pound basis of that loss. So going back to the example of litigation, if it was discovered during DD due diligence processes that the company did have a pending litigation claim against it, how you could deal with that is essentially provide an indemnity get sellers to provide indemnity in the agreement, which basically says that if it does arise and there is a costs decision that's made against the company in relation to that claim or that litigation, that the buyer will be reimbursed on a pound-for-pound basis for that loss. So essentially, it just means that about a certain potential loss that could arise in relation to the company, and you're essentially providing that you're going to get that loss back on a pound-for-pound basis. So it's slightly a better and improved position from the buyer side in terms of recourse.
And then picking up on sort of the actually named anonymous user. A user question. I suppose if you've identified an issue, there are other things maybe you could do. So if you can quantify the amount that issue relates, how much it's worth, you could reduce the purchase price by that amount. Sellers may not like it, but certainly on bigger deals, that's probably what you would do. If you can't quantify it, then potentially what you do is you hold back some of the considerations. So you could say, we think this is 50 grand, we're going to hold back 50 grand for a period of time. We expect during that period of time that we'll be able to quantify what the cost is, or if there is a cost. And then we'll pay out the balance or the whole amount if there's no claim at that point. It's obviously easier to do on a bigger deal because hopefully the numbers are smaller. On a distressed deal, you probably have to take a view. We actually had a problem like this on the case study deal. So as part of the due diligence, we actually the company's accountants identified a potential tax issue. We were able to quantify that was worth about 30 grand. And our client, the buyer, was pretty happy just to take that hit. They basically said, look, fine, if this comes to be a problem, we'll pay it. We're happy to take that liability on because they saw broader value in the deal. And had they reduced the deal price by 30 grand, it would never have happened. But I think clearly if that liability had been, say, 300 grand, I think the buyer probably would have walked away, and it would just have been a sort of non-starter in terms of trying to sort of balance that liability. Sort of connected with that in a way is actually earnouts. So earnouts are basically where you almost, it's not quite withhold, but you allocate some of the considerations to the deal to the performance of milestones post completion. So you might say, for example, 50% of the deals, 50% of consideration is paid up front in cash. The balance is going to be paid over a couple of years. As long as certain performance milestones are met by the business. Now, it's always a really interesting one, this, because a lot of buyers will think earnouts are an absolutely amazing idea. But Mary, tell us why, based on our experience, why earnouts are not necessarily as good for buyers as people think.
Yeah, so on a really broad level, an earnout mechanism is quite a complicated thing. It sounds pretty simple, but essentially it will lead to longer negotiations. There's a lot of stuff to sort of negotiate in terms of an earn-out the seller will want to tie down, because it will then depend on what the max consideration they get. Things like how the earn-out is calculated, heavily negotiated. And also, you know, once you come to pay out the earn-out and it's calculated based on the EBITDA or whatever calculation you've got in there, you know, what happens if that's disputed? You know, what dispute process do we go through? That's obviously, if it does happen, going to add possibly significant costs onto the transaction. You also might find that you're having to give away or be restricted in terms of conduct of business of the company moving forward. So the seller might want to restrict certain goings on in the business. You know, the buyer will still have ultimate control, but things like taking out, you know, the business in a certain direction, you might be restricted in that, as the seller will want to make sure you're not deliberately trying to restrict the max earn-out that they can get. And also, ultimately, it could mean we worked on a deal sort of last year where we actually were able to, where we initially had an uncapped earn-out. And so if you have an uncapped earn-out for your seller shareholders, you could end up giving away much more in terms of value than you originally anticipated. You know, it could be a good thing because the company's doing well. But yeah, I guess the overall purchase price you'd be paying would be way more than what you would have done if it would have just been cash on completion. So yeah, I guess a few considerations there to take into.
Yeah, and I always find that buyers will, by default, want to do an earn-out, and generally they want to maximise the proportion of the consideration that's allocated to the earn-out. And the logic is good, actually. It makes sense. Like they don't want to find that they've overpaid for a dud asset, so they want to minimise the upfront consideration and push as much of it as possible to the earn-out, because obviously the earn-out's only payable if the business performs. And that all makes sense. What I can tell you is that every single buyer who we've acted for who has agreed an earn-out has been distinctly less happy in practice about paying out the earn-out, because even though logically the business has done great, they've got a fantastic asset, it's done brilliantly well and it's had a load of value to their business, they're having to pay out a lot of extra cash. And so I think it's one of those things that's easy to justify in the context of the transaction and a little bit more painful after the transaction. I would say at the very least, on the buy side, never ever agree to an uncapped earn-out. The deal that Mary references was actually really funny, at least for us. So we were acting on the sell side, and the original term sheet had a capped earn-out, so it was absolutely capped. The sellers had very sensibly put quite conservative performance numbers for how they thought the business would grow post-completion. But the buyers were fixated on this idea that they thought they were overpaying, they were concerned the business wouldn't perform. And they actually negotiated away the cap on the earn-out in exchange for a downside protection, so protection if the business didn't perform. This wasn't a distressed deal, but our clients have walked away with about £25 million more than they would otherwise have got had that earn-out been capped. So I think my message is always just be a little bit careful about earn-outs and make sure you, on the buy side, know what you're getting yourself in for. And I guess on distressed deals, if we go back to our case study, you could have given and our clients did give 100 grand in cash, and that would have been it. Imagine if there had then been an earn-out instead. Potentially they could have given away 200, 300, 400, 500,000 pounds for exactly the same asset that was worth 100. So, you know, think through earn-outs. Perfect. Ivan, do we have any questions on that section? Indeed,
yes.
any of the sections?
Yes, actually, we do have a few questions. And the first question is from Flavian. How can we make sure that any management team we have onboarded stays with the business to help the transition?
It could be a concern of yours, you know, especially if one of the key reasons you're buying the business is because you want specific members of the management team to stay on. It could be they have client contacts, anything like that. And it could be a concern that, you know, if you sort of once you come to complete, that they sort of leave the business on day one after completion, and then you're, again, like we've been saying, you're left with a business that's not sort of totally what you thought it was. So there's a couple of ways you can sort of go about protecting against that. One really super standard thing that you'd see across all types of deals is restrictive covenants, and that would basically say that if that member of the team left within a certain period after completion, that they would be restricted in terms of working with competing business or setting up a business in competition, soliciting away clients, that sort of thing. Also, you could use, if you have an earn-out on your deal, you could use that to your advantage by sort of linking employment to the earn-out. It can be heavily negotiated, but essentially the buyer's position would be that if you leave on day one, you forgo your right to the earn-out. And so that's really going to be a huge incentive for the member of the team to stay on and help with any transition, and that could be the length of the earn-out. And maybe for a bit of time after. It really depends on the deal, but there's sort of two ways I think of maybe trying to make sure that you're not just left with a flight risk, I suppose, on completion.
Perfect. Thank you so much, Mary. That was fantastic answer. Next question is from Gloria. How long is the standard earn-out period?
Yeah, so it really depends. It's such a commercial thing, and again, it will be a thing that's heavily negotiated. We tend to see the commercial standard between 2 to 3 years after completion as the earn-out. It's going to depend, I guess, on whether you've negotiated an uncapped or capped earn-out. Obviously, if it's uncapped, you're going to want to wait a shorter period, ideally, and if it's not, then potentially you go a bit longer. But yeah, 2 to 3 years, I'd say, is probably standard.
Thank you so much, Mary. And thank you for all the questions, guys. We are just going to take 2 more final questions before we end. The first question is from Tayo. Rather than an earn-out, how does deferred payments work in such situations?
Yeah, so there's a couple of ways of doing it, but what you can do if you're concerned about sort of warranty breaches and you're worried that something may come out of the woodwork post-completion is you can simply just delay the payment. So you're not making it conditional on any performance metric. You're just holding back cash and having the ability to deduct any losses that you suffer from a warranty breach from that money. So putting in numbers, let's say 100 grand consideration, you pay 50 up front, you defer 50. The 50 balance gets paid 12 months after completion, unless there's a warranty claim. So it's just a way of sort of protecting yourself if something goes wrong. It's worth saying earn-outs can actually be used in exactly the same way. So it's very common to say that, the earn-out sums will be paid if the milestones are met, but less any warranty claim. And that's quite a sort of common thing to do. And earn-outs are quite a neat way of sort of balancing both warranty claims and potential lack of performance of the business.
Perfect. Thank you so much, Mike. And our final question for tonight is from Manvi. Why are hedge funds interested in buying distressed assets?
That is a super good question, the answer to which I have minimal knowledge. I probably take a punt and say that I think there's probably a couple of drivers. One, in the current market, distressed assets are generally often a very good deal. So particularly if you think about the startup space, the reason these businesses are going bust or potentially going bust or being put up for sale is not because they're inherently bad businesses or that they aren't going to work. It's just that the economic environment has changed. So, you can blame this on a lot of stuff, but I would start with pre-Liz Truss, but pre-Truss, Ukraine, all this kind of stuff. If you were a tech startup in the London market, you could comfortably expect to raise the Series A without too much trouble. Right now, VCs are challenging early stage startups. And if you can't demonstrate more traction than you would have needed previously, you aren't going to be able to raise money. So you've got these businesses that a year ago would have been fantastic businesses that now are basically going bust. Think about that from a hedge fund perspective. There's loads of value there that they can get on the cheap. So I think that's the first part of it. The second part of it essentially is that you know, less so I think with private companies, more so with public companies, but some of the hedge funds are pushing companies into a situation where they have trouble. So, you know, you can sort of see some of the stuff that's happened with banks where hedge funds have been shorting stock to bring the price down, and then, you know, investing and acquiring shares at a low value. So I think hedge funds are slightly funny creatures, but I think the long and short of it probably is they're able to pick up assets that are worth more than the price they need to pay for them. So fantastic. That's all the questions from us. Thank you all very much for attending. Our contact details are on that slide just there. If you do have any questions that you'd like to ask us later, feel free to drop us an email and we can set up a call or we can respond by email. Even if you need any help on any M&A transactions, then exactly the same. Drop us an email and we can pick it up from there. Thank you all very much.
Guys.